Hello friends, good morning to all of you, and this is the second video related to the module D, and we have already covered a part of the first chapter that was related to the components of the assets and liabilities, and now we are going to cover the rest of the part. So we were talking about the ALM, right? So do confirm the audio video quality at the earliest so that we can proceed. And further, if you're having any of the queries related to any of the topics of the BFM, you can let me know in the comment section after the session. Any of the doubts, any of the things, any of the issues related to BFM, you can post so that we can cover those things. So the audio video quality is working all fine. So let's start the session. So first thing first that we're going to cover today is about the objectives of the ALM. And when we're talking about the objective of the ALM, it's basically based on two levels. One, it's related to the macro level, like at the organization level, and the other one, it's about the micro level, right? At the micro level, like at the individual loan level, let's say we are going to talk about, right? So at macro level, we can say that the ALM is going to focus on the strategic balance sheet management. We have to focus on what? We have to focus on the strategic balance sheet management at the macro level. Balance sheet management. That how strategically we can manage our balance sheet, how the business and risk management policies can be made out of it, how the efficient allocation of the capital can be done, right? How we can be appropriately designing the pricing strategies, right? That's about it. What's our risk appetite and the regulatory norms. So at the macro level, at the bank level, we can be thinking about, and also at the micro level, we can be having some objectives at micro level. At the core ALM functions, we can be having the objectives, and that could be related to the profitability. Like we can be aiming at profitability through the price matching, or it could be related to the liquidity through the maturity matching. We can also be looking into the liquidity at the micro level. Getting it? So at the macro level, we are talking about overall formulation of the things, overall formulation of the strategies, or like we are talking about the appropriate pricing strategies in case of the macro level. But when we are talking about the micro level, we are talking about the profitability. We are talking about the liquidity, right? So that's about it. That's about the objectives. And then further, it's about the price matching. When we're talking about the price matching, we are talking about what? We are talking about the interest rate risk management. It simply is the interest rate risk management, that we want to maintain the positive spread. And positive spread will be made when we'll be having the interest earned greater than the interest paid. So if your interest earned, that the interest that you are earning is basically greater than the interest paid, right? Then we say it what? Then we say that we can be maintaining a positive spread. And we should be analyzing the key concept of the gap analysis, right? The key concept related to the gap analysis. The gap can be like, it can be a positive gap or it can be a negative gap. Positive gap means when you're having assets more than the liabilities, right? Let's say you're having more risk sensitive assets as compared to that of the risk sensitive liabilities. Now, what that will indicate? Now you are having the more rate sensitive assets. Now, if the interest rate increases, if the interest rate increases, in that scenario, you'll be having more gains or lesser gains. Definitely, if the interest rate is increasing and we are having the more risk sensitive assets, let's say the assets basically which are affected by a change of the interest rates are 200 crore, and the liabilities which are basically affected by change of interest rate, those are 100 crores. Now in this manner, particularly if interest rate increases both for the assets and the liabilities, will be making much more profit now if the interest rate increases, because we are having the positive gap. And what about if we are having the negative gap? That's the risk sensitive assets are lesser than that of the risk sensitive liabilities. Now we are having the more risk sensitive liabilities, right? And now if the interest rate increases, we will be losing money. We won't be gaining money, we will be losing money. And on the other hand, if the interest rate decreases, in this scenario, we'll be having gains, right? So the main thing it's related to, we want the stability. We want to control the interest rate risk. So price matching is all about what? Price matching is all about interest rate risk management. It's all about the interest rate risk management. The second concept under the micro objective was related to the maturity matching. And maturity matching is related to what? It's related to the liquidity management. It's about the liquidity management. Now, assets and the liabilities will be grouped together based upon the maturity profile, based upon the residual maturity, we can say. Maturity profile or based upon the residual maturity. Now, you'll be looking at a one particular time horizon. Let's say you're looking at 1 to 3 month period, and you're finding that the assets which are maturing over this time horizon, these are 200 crores, and the liabilities which are maturing over this time horizon, these are 300 crores. And now maturing assets are what? Maturing assets are the, we are talking about maturing assets. We are talking about the maturing liabilities. Maturing assets are the cash inflows. So we are going to receive 200 crores, and maturing liabilities are the cash outflows. We are to pay 300 crores, right? So in this particular case, you are having negative gap. So you are to assess the gap, and further you can be planning the liquidity requirements accordingly, right? So it can be helping you so as to avoid the liquidity crisis, and definitely it can ensure timely repayment obligations. Clear with it? So maturity matching is going to help you related to liquidity management, and the price matching is going to help you related to the interest rate risk management, right? After that, it's about ALM as coordinated balance sheet management. ALM as a coordinated balance sheet management. Why? Because ALM is going to integrate the asset side and the liability side decision for the overall financial stability. It's going to integrate it. It's going to integrate what? It's going to integrate the asset side as well as the liability side for overall financial stability, right? First of all, we are going to talk about the asset side management. Asset side management. Asset side management, like reserve position management, can be done, like maintaining the CRR, SLR as per the regulatory norms. That's the first thing. Liquidity management, that's going to ensure availability of cash and the liquidity assets. And for the investment management means maintaining the uh, SLR and the non-SLR investments. So even if you're having SLR investments and non-SLR investments, those will be covered into it. Loan management, like credit deployment and the portfolio quality, about the loan management. And fixed asset management means efficient utilization of the bank infrastructure assets. So these are the balance sheet functions, balance sheet management functions. Reserve position is related to CRR, SLR. This is related to SLR, CRR. Liquidity management is related to that we need to ensure that we are having the liquid assets available with us. Liquid assets are available, cash and liquid assets are available. Investment management means we have to manage the SLR and CRR, non-SLR securities. SLR or non-SLR securities. And loan management, we have to talk about the credit deployment and portfolio quality. And fixed asset management, about the efficient utilization of the bank infrastructure assets. And what about the liability side management? When we're talking about the liability management, it's about we are to mobilize the deposits and borrowings, that we are to mobilize more deposits, we are to borrow the funds. Two things are there. Either we are mobilizing the deposits, right, or we are borrowing the funds. And second one is related to reserve position management. Like we are to maintaining the regulatory reserves. Whatsoever the regulatory reserves are there, we are to maintain those. For the long term borrowings means raising the funds through the debentures or through the notes or through the bonds. And capital management, we have to maintain the capital adequacy. That the capital adequacy is to be maintained. So this is related to coordinated balance sheet management on the asset side as well as on the liability side. Then it's related to income expense functions, income expense management under the ALM. Now profit is will be calculated. How the profit will be calculated? What is the profit equation? The profit equation is like whatsoever the interest income, we are to subtract the interest expense. Whatsoever the provision for the loan loss is there, that is to be subtracted. And whatsoever the non-interest income is there, that is to be credited. Whatsoever the non-interest expense, that is to be subtracted. And whatsoever the taxes, those are to be subtracted. That is your profit equation. This is your profit equation. So this reflects overall performance under the ALM framework. Clear with it? And the key policy objectives under the ALM are what? The key policies that we want to achieve the spread management. Spread management means we need to maintain the profitable NIM, healthy NIM, net interest margin is to be maintained. And when we're talking about the loan quality, we are to control the NPAs and credit risk. Fee-based income means we need to increase the fee generating income, service charging income for us. Cost control means we need to reduce the operating expenses. We need to reduce the operating expenses. And further, tax management means the tax efficiency, so as to optimize the tax liabilities. Capital adequacy means that we are to maintain the CRAR as per the Basel III norms, that is to be maintained. So these are the policies so as to achieve the objectives of the ALM. Right? These policies are to be maintained. Clear with it? So that was about the chapter number 1 related to the components of the assets and liabilities. The next one, it's about the capital adequacy. The next chapter that we are going to cover, it's about the capital adequacy. That's from the module D. So the first topic that we are going to cover about it is related to capital adequacy. It's about to capital adequacy itself, that we are to maintain the capital as per the Basel III norms. That's basically the point. But where it is applicable to the commercial banks. To all the commercial banks, it is applicable, but not to the cooperative banks, not to the local area banks, not to the regional rural banks. So the revised capital adequacy norms, these are applicable to whom? These are applicable to all the commercial banks, but not to the cooperative banks, not to the local area banks and the regional rural banks. And further, if we look at the level of application, it's basically applicable at the solo level and also at the consolidated level. Solo level means the global position of the individual bank, right? So when we're talking about the solo level, it means we are talking about the global position of the individual bank. And when we're talking about the consolidated level, it means entire group, including the subsidiaries and associates. So it's available at solo level and also at the consolidated level. Now, what's the definition of the consolidated bank? Consolidated bank means a group where a licensed bank is a controlling entity. So let's say we are talking about the HDFC. So HDFC is what? HDFC is a licensed entity, right? But it's a controlling entity. HDFC Bank is a controlling entity of the other subsidiaries which are there under the HDFC, right? So it's a consolidated bank. So it's basically a group. It's basically a group where a licensed bank is a controlling entity, and it is going to include all the entities which are under its control, which are under its control. Clear with it? And the regulatory requirement says that the consolidated bank must be maintaining the CRAR on the solo basis and also on the consolidated basis. So it is required that on solo basis, individually, this bank itself, and also on consolidated basis means whatsoever the entities are there, right? Whatsoever the entities are there, those are also to maintain the this particular CRAR. After that, it's about the three pillars of the Basel III framework. We already know that. And Basel III focuses upon what? Basel III focuses upon the capital adequacy, that the proper capital should be maintained. The first thing it focuses upon is the capital adequacy. The second thing it focuses upon, it's about the risk management. And the third thing, it's about the transparency. That's a market discipline, we can say, right? So these are the focus areas of the Basel III framework. So pillar one is all about what? It's about the minimum capital requirement. We already know that there are the constituents of the capital. Like under the pillar one, it's going to cover the three major risks. One, it is related to the capital structure. Capital structure like that we are to maintain the capital for what type of risk? For the credit risk, market risk, and operational risk. Right? That is to be maintained. And the capital is to be maintained in the form of tier one capital and the tier two capital. That we have already covered under the module B. Completely, we have already covered that particular part. And tier 1 capital is further divided into two parts, CET1 and AT1, right? And when we are to maintain the capital for the credit risk, we are having the three approaches. One, it is the standardized approach. We say it to be SA. And the other two approaches are the IRB FA. One, it is the internal rating based approach, foundation approach. And the other one, it is IRB, internal rating based advanced approach. Right? These are the IRB approaches. And for the market risk, we are again having standardized method and the internal model method. Standardized approach, maturity method, standardized approach, duration method. And for the operational risk, we are having the basic indicator approach, standardized approach, we say it to be TSA, and the AMA, that is advanced measurement approach. These are the different approaches we are having under the minimum capital requirement, right? And further, if we talk about the pillar two, if we talk about the pillar two, now the pillar one provides a minimum capital, but it does not cover the complete risk. The full risk is not covered over here. So banks have to maintain the additional capital so as to cover the residual risk also, so as to cover the actual risk profile also. So the risks which are not captured under the pillar one, there are many risks which are not captured fully. Like it is a interest rate risk in the banking book. It is an interest rate risk in the banking book, which is a part of the market risk, right? Credit concentration risk, which is not covered, which is part of the credit risk. Liquidity risk for convenience sake, including the part of the market risk. And settlement risk, which is also called the counterparty risk, is part of the credit risk. Reputation risk is not covered. The strategy risk is not covered, right? So many risks are there which are not covered. If you're talking about just the credit risk related risks which are not covered, that's basically like the credit concentration risk. Let me just tell you that which are the credit risk related risks which are not covered. First of all, it's about the credit concentration risk. Then the counterparty risk or the settlement risk. This is not covered. This is also part of the credit risk. Then further, it's about the model risk. Let's say if there is any issue with the modeling, right? Underestimation of the risk. So that's basically the model risk, right? So this is IRB underestimation. And further, other than that, the weak credit risk mitigants, if those are used, if the weak credit risk mitigants, those are used, those are also part of the credit risk. A residual securitization risk. Now, even if you do the securitization, it basically there is part of it which can be part of both credit risk as well as of the market risk, right? So that's about it. And when we're talking about the market risk, it's about the internal rate risk in the banking, interest rate risk in the banking book. That's the market risk, right? And when we're talking about the liquidity and operational risk, it's about the liquidity risk first of all, and further it's about the reputational risk, that if you are not having the liquidity with you, right? And also it's about the strategic risk that also leads to the operational risk, right? And there are emerging risks also. There are emerging risks also, like in the case of the climate risk is a emerging risk, right? And payment and settlement risk is a emerging risk. So these are the risks which are not covered under the pillar 1. So for the SRP, we are having the 4 key principles. That's for the security, for the supervisory review process. For the SRP, we are having the 4 key principle. Principle 1, it's related to the internal capital adequacy assessment. Principle 1, it's related to the internal capital adequacy assessment. That is ICAAP. ICAAP. So bank must be assessing the capital adequacy based upon the risk profile, based upon the business strategy, right? Bank is to assess the capital adequacy. So banks must be having the process so as to assess the overall capital adequacy. There's an internal capital adequacy assessment. That's a key one principle. Principle number 2, it's about the supervisory evaluation. Means the regulator. Supervisory evaluation means the supervisor must be evaluating that whether the process which are being followed under the internal capital adequacy, those are sufficient or not. So the regulator is to evaluate the bank's internal assessment. The regulator is to evaluate the compliance with the capital norms, right? And the correct action is to be taken if it is required. That's the pillar, principle 2. The principle 3 is basically that the capital must be above the minimum level. It's not like that you are having the minimum capital and that's it. So you must be having the capital that must be above the minimum capital ratio. And supervisory basically do mandate that the additional capital buffer should be maintained, like in the case in the form of the capital conservation buffer and all that should be maintained, right? So that's a part. And the fourth point is related to the early supervisory intervention. The fourth point, it's about the early supervisory intervention. So we can talk about the 4 principles, P3 and P4. First one was related to what? The first one was related to the ICAAP, internal capital adequacy assessment, right? The second one, it's about the supervisory evaluation. The third one, it's about the capital above minimum level, so that you can be retaining these principles, right? So this is the third principle. And the fourth one, it's about the early supervisory intervention. Like if something goes bad, right, the supervisor must be intervening at an early stage. So these are the 4 principles related to the pillar number 2. Clear with it? Do confirm that if you have understood the topic so far. These are the very basics that we have already covered under the module B, right? Nothing new that we have covered so far. Then the next topic, it's about the ICAAP procedures and measures. So what are the core ICAAP requirement? The core ICAAP requirement is related to identification and measurement of the risk, identification and quantification of risk. Like under the pillar one, we have already covered the risk like credit risk, operational risk, market risk, but there are other risks also which are not covered. So we want to cover them all. So the first step would be related to that we need to identify the other risks. We need to quantify the other risks. That's the step one. That's a core ICAAP requirement, first of all. Right? And also, we should be maintaining an appropriate level of the internal capital that should be aligning with the risk profile. And we should have done the development and continuous improvement of the risk management system. So it should be also developed. It should be modified accordingly, right? Continuous improvement should be there. That's about it, right? So whenever we are talking about the SRP, supervisory review process, it's basically a regulatory review mechanism. It's a regulatory review mechanism. The pillar 2 basically say that you should be having an ICAAP so that you can be making sure that you are having appropriate capital as per the risk profile. At the same time, the regulator will be evaluating it, the ICAAP framework, the risk assessment accuracy, and also the capital adequacy. So that is to be reviewed by the regulator only, right? Further, let's have a structural aspects of the ICAAP. Structural aspect of the ICAAP. So whether when we are talking about the bank at the solo level, because I told you that the application is at the solo level and the consolidated level and the consolidated level. When we are talking about the solo level, definitely it is ICAAP is mandatory. ICAAP is mandatory at the solo level. And when we're talking about the group level, like each entity does require, it is also required for each entity. And it is also mandatory at the solo level. So whether we are talking about the solo level, group level, or consolidated level, the ICAAP is required, right? And it basically should be available firm-wide level. So like all the risks in the different business lines should be covered. And further, all the on-balance sheet exposures, off-balance sheet exposures, those must be covered. So whether we are talking about the on-balance sheet exposure or off-balance sheet exposures, right? Those must be covered. After that, it's about the key features of sound risk management system. So if you're having a risk management system and you want it to be sound enough, so what are the features of the same? So first thing, it's about the active oversight by the board and the senior management. There should be active oversight by the board and the senior management. And definitely it's about the policies, procedures, and limits must be there. There should be the limits, the policies, the procedures should be clearly defined and documented. Those should be clearly defined and documented. And then it's about the identification and measurement, mitigation and control, and reporting of the risk. That should be comprehensive. Like it should be done comprehensively and it should be done timely when we're talking about the identification of the risk, quantification of the risk, mitigation, controlling, monitoring, right? So that should be done comprehensively and that should be done timely. Further, it's about monitoring and reporting is also to be done on continuous basis. When we are talking about the monitoring, when we are talking about the controlling, right? We are talking about the risk management system now. So first of all, the board must be participating actively, the senior management must be participating actively, proper policies and procedures must be there, those should be defined properly, those must be documented. proper processes must be there. Those should be comprehensive and those should be timely implemented. Proper monitoring is to be done. You should be having a proper communication system where the data is properly stored and further properly communicated and available firm level wise, right? Firm wide level, if it should be available. And comprehensive internal control should be there. Like, let's say we're talking about the strong checks. We are talking about the strong checks here. That should be here. So those are the features related to the sound risk management system. Now, the ultimate responsibility when we're talking about designing of the ICAAP or something, that lies with whom? Related to designing and implementation of the ICAAP, that lies with the board of directors. So when we're talking about any type of the risk, the ultimate responsibility is with whom? The ultimate responsibility is with the board of directors. In this case also, it is the responsibility of the board of directors only. And ICAAP structure, design, content, everything, that must be approved by the board. That must be approved by the board. Now let's have a look at the responsibilities of board for risk management purposes, or let's say for ensuring sound risk management, the board of directors should be doing what? So we can be talking about the responsibilities responsibilities of board of directors for the risk management purpose. First of all, it's about the risk governance. It's about what? It's about the risk governance, we can say, that the appetite limit must be set. That what is our appetite? What is our tolerance level? Right? That must be set. And also the overall risk strategy must be defined. So when we're talking about the risk governance, it's about the limits, it's about the risk strategy, the overall risk strategy. So that must be looked into. And at the same time, there should be oversight by the senior management. Oversight by the senior management. Like, the risk management framework must be there. If there is any risk exposure, that should be monitored properly, right? And we should be linking the risk with the capital and reserves. That's very much required. That first of all, it's about what? It's about the risk management framework. A proper risk management framework must be there. Let me highlight these points. Proper risk management framework must be there. Proper monitoring is to be done. A monitoring system should be there. We should be comprehensive, right? And we should be linking the risk to the bank's capital and reserve funds. Senior management must be doing that. And also, the senior management is to make sure that we are conforming with the internal policies. Whatsoever the internal policies, we are conforming with it. Whatsoever the risk guidelines are there, relevant policies and procedures are there, those must be followed. Those must be communicated, right? That must be taken care. Third one, we can say it's about the internal controls, that we should be having the strong internal controls. Those must be there. The written policies and procedures should be there, right? Appropriate strategic plan should be there in place. These are the responsibilities of the board of directors, right? So whatsoever the capital expenditure it is anticipated, that must be taken care of. What are the current needs, future needs, those must be looked into, right? So that's about the responsibilities of the board of directors, senior management, and the controls that must be there. Then after that, it's about the policies, procedures, limits, and controls. So banks framework related to risk management, that must be ensuring what? First of all, it's about the risk management process. The first thing, it's about the risk management process. right? So there should be timely identification, quantification, monitoring, control, and mitigation of the risks. That's required. And also we should be recognizing the risk nature. Whatsoever the risk nature is there, that should be identified, that should be recognized. Like it's a reputational risk, whatsoever the valuation uncertainty is there, those all things must be looked into. And we should be aligning the overall risk appetite with the business goals. So the whatsoever the policies we are having, those should be aligned toward the bank's objective. Those should be consistent with the bank's objective, the strategic goals, the stated goals. And definitely there should be an accountability framework, that what are the rules, what are the responsibilities, and how the reporting is to be done, right? So that should be clearly indicated. We're talking about the policies, procedures, limits, and controls, right? So proper uh, accountability must be there. Roles and responsibilities should be properly defined, and proper reporting hierarchy should be there. Then further it's related to, if let's say if there were any internal limits which were breached, that should be properly looked into. Those should be properly detected, and the issue must be escalated promptly. It's not like that the limit is there, it's breached and nothing is done, nothing like that. If there is any breach, that should be detected, and further that should be escalated promptly, right? And let's say if we are doing any new product launch, or we are entering into any new businesses, that should be reviewed properly. Like the pre-launch risk should be evaluated by the risk management team. There should be the control functions related to it, right? That should be taken care. And periodic review should be done related to these policies. Periodic review, that should be there, related to policies, procedures, limits, and those should be updated also based on the market changes related to the risk profile, risk environment, that must be looked into, right? So that's about the policies and the limits. The next one, it's about identifying, measuring, monitoring, and reporting the risk. So definitely it's about the ICAAP. It's about what? It's about the ICAAP, that whatsoever the risk is there, right? This is a core requirement related to it. Core requirement related to it, that the bank must be having, that the MIS is going to provide the regular, accurate, and timely information. So whatsoever the risk that is identified, that must be captured. First of all, that must be captured. That should be identified. And that should be quantified, that what quantum of risk is available. It should be properly monitored, and it should be reported. It should be documented properly, right? So it will be helping in proper decision making. It should be ensuring the transparency in risk exposure. That's it. Then the next one, it's about the internal controls. Internal controls. Now the risk management processes should be monitored properly. Continuous monitoring is basically required. Independent testing must be there. So when we're talking about the internal controls, we are talking about the risk management processes, and the continuous processing first of all should be there. The continuous processing must be there. At the same time, testing should be there. Independent testing should be done. And it can be done through the internal audit, like periodic review of the systems and controls. It could be the external audit, like independent validation by the external auditor, or it could be the auditors, like the risk control units could be there, right? So as for the continuous monitoring, purpose is what? That we want to ensure accuracy and reliability of the data. So the internal controls are like the internal limits, right? And for that particular purpose, internal audit, external audit, and the risk control units are there. The main purpose is that we want to ensure the accuracy and the reliability of the data. We want to strengthen the decision making framework, right? So all these things must be looked into related to the internal controls. Further, it's about the submission of the reports or what's the outcome of the ICAAP that is to be submitted to the board of directors and also to the Reserve Bank of India. So ICAAP outcome that must be approved by the board of directors. So what's the outcome that must be approved? Approved by whom? Approved by the board of directors. And then it is to be submitted to the Reserve Bank of India, the outcome that must be submitted to the Reserve Bank of India. So ICAAP should be reflecting the risk profile, capital adequacy, risk management framework. It should be showcasing you the same. Then it's related to review of the ICAAP outcome. That's basically required that at least annually, at least once in annual basis, it should be reviewed. The ICAAP outcome should be reviewed at least once in a year. And it will be the responsibility of the board of directors always and always. Always and always. It's the responsibility of the board of directors related to the framework, related to the risk management framework, related to the ICAAP itself. So if there is any necessary modification is to be done, that should be done. And also it should be aligning with the evolving risk environment. So whatsoever the risk profile the bank is carrying right now, it should be aligning with the same. That's about the review the ICAAP outcome. Then further, it's about the principle of proportionality. Principle of proportionality means the ICAAP system can be very much sophisticated for a huge, complex, structured bank. Like there are the multiple factors that should be looked into. Like it could be the nature of the business, scale of business, complexity of the business, scope of the business. So for the small banks, a simple ICAAP could be there. And for a large or complex banks, the advanced ICAAP systems should be there, right? And if we look at that, you are having a very simple bank. Let's say if the practices are very much simple, then what should be the approach? For simple banks, what should be done? First step, it could be related to that we are to identify the major losses in the last 3 to 5 years. We should be having the assessed if those can reoccur, and we should be preparing the short list of most significant risks. That the part number one. That is the approach we are talking about. This is the approach we are talking about. Further, it's about the capital assessment. About what? It's about the capital assessment. That we need to estimate the capital required, that if the risk is going to materialize. That if this risk materialize, like first of all, we having the approach, we identified the major losses in the last 3 to 5 years, right? And further, we looked at the part that if those can reoccur, we just prepared the list of the most significant risks over here. And then we find out that what capital would be required so as to absorb such risk if those risk materializes. And what will be the impact on the bank capital requirement later on, right? So we have to look into it. Clear with it? And further, scenario analysis must be there. That what is the change in the capital requirement? What is a change in the capital requirement? So the proper scenario analysis should be there. The third one we can say about the scenario analysis and the documentation. So we should be looking into what is the change in the capital requirement. Previously, what capital we were requiring, and now what capital we are requiring. So what is the capital adequacy which is required under the stress situation also. Scenario analysis must be there. And capital range estimates must be prepared. That's about the documentation part. This particular point. This is related to you're defining the different scenarios, and further you should be looking into the ranges of the capital which is required. Let's say we do require the capital range from 1000 to 1200, right? So it's about it that we should be maintaining the capital range estimates, right? And further, active involvement of the senior management should be there. Active involvement of the senior management should be there, right? So that's about. And what about the moderately complex bank? If the practices are moderately complex, in that scenario, what is to be done? Let's have a look at it. So first part first, it would be related to the risk identification. That we are to identify the risks. Whatsoever the risks were there, we are to maintain a comprehensive risk inventory. That what type of risks were there in history, right? And we can be measuring the risk using the historical data. So it will be about the risk measurement, and that will be done through using the historical data. We are to measure the risk. We are to estimate the losses, the loss distribution. We are to look into the probability ranges. So we will be going for the for the particular loss distribution, and also for the probability ranges based upon the historical data. And then we'll be going for the capital adequacy assessment, that whether we are having the proper capital with us or not. Capital adequacy assessment, that is to be done. That would be the part number 3. That on that particularly is existing capital adequate? Do we require additional capital for this, right? So we are going to estimate the additional capital required. And further, we should be considering the model risk at this particular time. What risk? Model risk. Because we adopted a model using which we identified the risk. It could be the case that we have done the incorrect assumptions. It could be the case that we have the estimation errors. So we should be looking into the fact. We should be looking into the fact. We should be having the model risk consideration. Further, we should be having the business projection. Like for up to 1 year, we should be having the detailed projection. Up to 1 year, we should be having the detailed projections. And for the 3 to 5 years, we should be having the broad objections. Like not that much detailed, but the broad projections must be there. And also we should be having the stress testing done. The stress testing must be done. Why stress testing? Because we are to look into the adverse economic conditions. If the business is under performance, we should be looking at the adverse economic scenarios. That is to be done. And also we should be planning that how we will be responding. Response planning, that in stress testing is done based upon the results. We'll be doing the response planning, that how what will be the impact on the capital, and how we will come over that particular thing, what will be the strategic response toward this stress. And also the proper system validation should be there. This is the last part, that's about the system validation. That should be there. Like whatsoever estimates were there, we have to review the accuracy of the same. We have to validate the assumptions. So the proper system validation is to be done, right? So this is a process that is to be followed in case of the moderately complex bank. So first thing first was done related to what? Risk identification we did. Then we did the risk measurement. Further after that, the capital adequacy assessment was done, and we are to identify the model risk. And further, the detailed projection is to be done for up to 1 year. Broad projection is done for up to 3 to 5 years. Stress testing is to be done, and further, the response planning is also to be taken care of. Then the system validation is to be done. So this is the process which is to be followed for the moderately complex bank. Further, it's about the regular independent review and validation. As I told you, that is ICAAP should be going for a regular independent review. Like periodic internal audit must be there. I told you already, at least once in an annual basis, it should be reviewed, right? And internal audit must be done, independent review, internal audit must be done, and also the external audit must be done. So it ensures that the ICAAP is comprehensive, it is proportionate, like, right? It is proportionate, it is aligning with the regulatory expectations. That's why it is very much required, right? And at the same time, this ICAAP we are talking about, ICAAP we are talking about, it should be a forward-looking process. ICAAP, it should be a forward-looking process. It should be prospective, right? It should be prospective. It should be focusing on the future risks and capital planning. Like it not be just talking about the historical data, but should be looking in the future that what things we may be requiring, what capital needs may be there, right? Like we should be estimating the future capital requirements. If we talk about the utilization, like the expected deployment of the capital across the different business lines, bank's desired level of capital, like target capital buffer that we need to maintain, the limits related to capital means internal threshold for the capital adequacy, contingency planning, like if there is any contingency, if there is any risk which is crystallized or adverse scenarios are there, how we are going to basically come over that. So main purpose is related to what, that we want to ensure the sustainable capital adequacy. Main objective is we want the sustainable capital adequacy. That's the main thing. That's what we want to achieve, right? Clear with it? Further, it's related to ICAAP so as to include the stress testing and the scenario analysis. So when we're talking about the stress testing, we are to talk about the extreme things, but plausible, which are possible. Extreme but plausible scenarios we are talking about. Like the interest rate is increased very sharply, there is economic slowdown, or NPAs are increasing very rapidly. That's the stress testing. And when we are doing the scenario analysis, it's about we are to evaluate the impact of multiple variables. Scenario analysis means when the multiple market parameters or multiple market variables, those are moving simultaneously. So there could be multiple scenarios, lakhs of scenarios, hundreds of scenarios would be there. And what would be the objective? So what will be the objective related to it? We want to identify the vulnerabilities. Why we want to do the stress testing and scenario analysis? So as to identify the loopholes, identify the vulnerabilities, right? That's the first part. And also so as to do the capital planning in the adverse scenarios for the different scenarios. And so as to do a proper decision making in those scenarios. So that is a major purpose related to the stress testing and the scenario analysis. So that will be all related to this video. I hope that you must have liked the content related to it. So make sure to like this video and further share this video. If you want to get the complete course, crash course for the CAIIB, simply just do WhatsApp writing CAIIB. Just do write CAIIB and WhatsApp it to the number 83609 44207, and I'll be sharing all the details with you. Thank you so much and see you again in the next video.